So happy Friday, everybody. Glad you could join us. Hi, Lisa. Hi, Phil. Phil, looks like you're just listening, and Lisa, you are sitting front and center and have some questions. Perfect. So hopefully some other people will join us as well. I have with me today Marissa, who works for, should I say accounting specialist?
Accounting.
Tax accounting? Okay, tax accounting. So perfect.
And bookkeeping.
And bookkeeping. And then I have Ron also, who EntreCourier has a lot of knowledge in this. I'm kind of going to let them run the conversation today. I'm going to be just kind of sitting back, taking a lot of this in as well. If I have questions, I'll be popping them in. And if you guys do, put them in there and I'll put them up on the screen. Other than that, though, I'm going to kind of let these guys just have a jumping off point and start talking about some things. And if you guys want to know anything specific, give it a shot. So okay. Marissa, I will hand it over to you and let you start.
First of all, thank you, Steve, for having us. Thanks, Ron, for coming on. Hi, everybody in chat. Looks like we've got Lisa and Phil and Mort and Nick and Roy. If you guys have any questions, feel free to answer. I think we're just going to talk about filing taxes for gig work today and the process and what's involved.
Yeah, I noticed something, and Steve, thanks for having me on also. And I noticed something on my website, because I do have a lot of tax articles on there, that it's like it really peaks. Yeah, I hit a really big spike in January, and then it kind of slows down through February and March, and then April again, it's going to spike back up again or something like that, because it seems like those are the two times that people are saying, oh, crap, taxes. And so... Right. You know, and they're starting to look for, okay, what are we going to have to do? You know, either they get their 1099 and they want to know what to do with it, or now it's getting close to April and it's kind of like, okay, we can't keep dragging our feet. I guess we got to do something about it. So
we're already some good advice. Don't forget to file.
Yep.
We have to file taxes. Yes, we do.
We got to file taxes. That sucks.
I mean, you don't. Here's where I shouldn't speak anymore, because you don't have to. But there's a bad outcome if you don't.
Well,
consequences.
It's just kind of whether they notice or not, huh?
Yeah. So, but from here, I don't know, Marissa, do you want to? I mean, you could start off with some expenses. You could start off with like just some basic how-tos, what gig workers receive in the mail, and maybe how to organize them, especially if they're multi-appers. I'm just kind of popping off some ideas here. Right, of the jumping points. So, because I think it'll flow once it's moving, but I think that, you know, just some information starting to come out will raise questions.
Sure.
Well, I would say, first of all, if you're a gig worker, you're going to be getting some 1099s. If it's Uber, Lyft, DoorDash, all of those, your regular income that they pay you is going to come on a 1099 NEC. You may also get a 1099K. With most of these delivery and driving companies, they're not duplicated, meaning what's on the Schedule K is different in addition to what's on the Schedule NEC.
Yeah.
So you would add them up as your income, and you're going to write off a bunch of expenses against that to lower your income to give you a net profit, which is what is taxed. Mm-hmm. It's that taxable amount that you're aiming to get towards. So the more deductions you have, the less taxable amount, the less you're going to be taxed on it. So you always file a 1040 generally as an individual, and with that you'll be adding on a Schedule C with your business expenses, which is separate from your personal, but they're all going to go on the same 1040. Hope I'm not being too confusing.
No, I don't think so. You know, I think it's just that topic of taxes that kind of freaks people out to begin with. And so it's like, you know, just you mentioned the word, and anything to do with taxes a lot of times just feels confusing, even if it's not. I don't think that if you kind of know at least the basics of how it works, that it has to be as complicated as sometimes we freak ourselves out into believing that it is. A lot of the little details can be pretty complex, you know,
Right.
like things like the way that the IRS orders all of the different deductions on the tax form and everything like that. It can be kind of confusing. You know, you think, why did they do it that way? But,
Right. I mean, really, as a rideshare driver, there's very few items that you're going to be putting in your
right.
on your Schedule C. It's going to be your income and your probably you'll use the standard mileage rate. That is usually what people would use. There are instances and times when you might do actual expenses for your vehicle.
Mm-hmm.
But usually you're just going to track your miles. And this year it's 56 cents per mile is what you get as a deduction. And then you have your commissions and fees, which comes right out on your summary report. They show you what these commissions and fees and taxes are that the rideshare company is going to charge against your income. You definitely want to deduct that off of the income.
Yeah, and that's the thing that confuses a lot of people with Uber and Lyft in particular, and Uber Eats as well, is that when you look at their tax summary, they'll say that you made $15,000 and you only received $10,000. And you're like, why are they saying I made so much money? And it has to do with the way it's kind of like these on paper commissions or something like that, or that, you know, I think Uber calls it their service fee. And it's, you know, so Uber will say you made $15,000, but we charged you a $3,000 service fee. So you actually only received $12,000, but you want to make sure that you're reporting the $15,000 as the income and then writing off that $3,000 under the commissions and fees.
Right.
And
right. So it is important that whatever you get on your 1099s is entered as income.
mm-hmm.
However, definitely some of that you get it back out right away because you probably didn't even receive it, which would be the commissions and fees that Uber charges.
Yes. Yes.
And the other things that you might have on there, really, I mean,
everything else is really small compared to the miles, you know.
What is this?
I said everything else is really small compared to the miles.
Right.
And so I think, you know, one thing
have a tax filing fee, like a legal and professional service. Like if you pay someone to file your taxes, you could write that off against your income. You can write off a percentage of your cell phone.
Right.
One safe way to do it is, like, say you drove 10,000 miles last year and your rideshare miles were 1,000. You then have 1% of your car was used for your business, and you could, 10%, sorry, and you could translate that to your cell phone. Some people do it that way.
Yeah, I think that's one of the questions that I've never seen a definitive answer, because I don't think anybody's ever really probably dove into the weeds enough or whatever to how do you determine what percentage. Some people will do it based on, okay, if I'm delivering for 20 hours a week, it's kind of like half time or something, so I'll write off half of it. But I haven't seen a standard. Maybe you have. I don't know. You know, the best thing that I've seen is what you said.
Honestly, I wrote off when I was doing rideshare. I did 50%.
Yeah.
I figured that my phone was in full use when I was driving, and that was, you know, I just documented it. I can't swear by that. Honestly, all our clients do it differently depending on the business. But
yeah.
If my company only pays me 40 cents a mile, can I deduct the 16 cents on my taxes?
What about for people who use two phones and one is only for this? I mean, even if they don't use it much, they have a second line that's their second line to do this.
If you can make a strong case that there is absolutely no personal use on that phone, then you could probably do it.
And then 100%. Still do partial on your other one?
If you're using it partially for your business.
Yeah, that's how they do it.
Sure.
That's how they run dual apps.
Yeah, I would say in that situation you would, and maybe you would do your 50% on the one phone and
100
100% on the other. If you're doing
So,
two different
Roy,
phones.
I'm looking at your question. I'm not fully sure I understand. You're getting like
I think
your
he's
company
asking
pays
why
you
he
a
can only
check.
deduct 40 cents instead of the
So they give you-
58.5 or whatever it is this
Your
year.
company pays you 40 cents for every mile you drive.
As an employee,
That's income.
yeah. Well, if they give you
Is
a
this on a
reimbursement,
Schedule C or are you getting it on a W-2?
that's a
Yeah,
good
but
question.
if they're paying him and then and then he even knows that amount, they're paying him 40 cents a mile. How can they pay him less than the standard?
They don't care about what the IRS and your company do. They don't have to be in sync.
Right.
The company is just doing something on their own. They're just going to reimburse you 40 cents a mile for everything you drive. Now the IRS is going to give you a deduction completely separate. Doesn't matter what your work's paying you. They're going to give you a deduction of 6 cents per mile that you drive.
Yep.
Is it,
Ultimately,
is it
that's between
58.5?
you and your employer,
Right.
as far as how much they're going to reimburse you.
Is it
So
still
that 40 cents a mile would basically look like income of some
so
form.
Roy, see right here what you're saying though. I think that was just answered. So no, yeah, Domino's pays you 40 cents a mile. That's just what they pay you per
Mhm.
mile.
That's
That's to
income.
you. That's income.
Yeah.
So you're still going to write off the entire.
No, not as an employee, unfortunately.
Are
Under
they
the
giving you a 1099 or a W-2, Roy?
that's the important thing there. Because
if they're
you're
giving you a W-2, you cannot write off your employee expenses unless you're military, I believe. However,
Right.
if it's a 1099, then you get to deduct.
I think that's his W-2 job, to be honest.
yeah.
Yeah,
He
just
said W-2. Yeah, if you are an employee, part of the tax jobs or the TJ, whatever it was, Tax Jobs and Cuts or Tax Cuts Act, in 2017, they changed that to where you could not any longer write off unreimbursed expenses as an employee. So unfortunately, all you get is whatever they reimburse you. And if you were 1099, then that, and what happens is like that 40 cents a mile is not included in your W-2. It's a reimbursement. And so it's not taxable income as an employee, or if they did it right anyway.
Right.
If you were
1099.
Yeah. If you were 1099, then it would be kind of like what happens with DoorDash and Grubhub and everybody else, where it's like, it's just lumped in with other income that you get. And it's not really a reimbursement. It's just taxable income, but then you get to write off the full 56 cents or actual expenses, if that's the better way to go.
It's weird because I feel like Domino's is in one of those, even though it's not, it's a W-2 job straight up, but I feel like it's in one of those limbo positions where you're kind of using your car for a pay that isn't correct based on the fact that you're using your car. Remember back in the days when like Domino's had cars and you would drive a Domino's vehicle?
Yep. It kind of varies from state to state, I think, too, as far as what the requirements are. Essentially, it's kind of between you and the employer. In some states, they have to pay you a full reimbursement for whatever your cost is of driving. And most employers in a lot of those states, I think, will default to the IRS rate because it's just easier. And then it just, I think it kind of varies state by state as far as what they require as far as reimbursing. But in most states, they have to, it's, I don't know about most states. I know a lot of states anyway, they do require that an employer now reimburse you for the cost. And if you can document that your car is actually costing more than that 40 cents a mile, then you might be able to get them to bump that up, or you might have a case to make with the state, different things like that. It's just, it's a state by state type of thing. But typically 40 cents a mile, especially with a lot of driving, unless you're driving, like a brand new car, or a fairly new Mustang, or some high value car that has a lot of depreciation, you're probably not going to see your actual cost be more than 40 cents a mile.
I'm sorry, I wasn't laughing at you. I was laughing at this comment.
We all did, you see?
Yeah, I'm just trying to keep up with the crowd, man.
Right.
I don't know if this was a joke or what this is either.
I don't know what PFT means.
Is it part full-time? I don't know. Huh.
Yeah, I think.
But regardless,
Middleton Tech, anything that is bought solely for business purposes should be able to be a write-off, and that's what his tax guy says. And essentially, what it is if something is, you need that for your business, you need to get that, you need to use that to operate your business, and it's a reasonable and ordinary cost of operating your business, then generally that's the word, is it's a legitimate expense in most cases. Some people will twist that, and they'll twist it a lot to try and write off some things that they shouldn't. But that's the general IRS rule, is, what is it, reasonable and ordinary, I think it is, or ordinary and necessary.
And they really do judge that by what is ordinary and necessary. I mean, if everybody has a car for their business to drive, and you've got one that's worth 80 times that, that's not reasonable and ordinary,
right,
for you to drive your clients around, unless that's what's, you're in West Hollywood, that's what people do, maybe.
Sure.
But most people really can look at their situation and kind of figure what's reasonable and ordinary.
Yeah.
It's kind of a common sense.
And that's, and that's something to really think about in terms of a lot of the, kind of those fringe things that people ask about with taxes. Your meals. Can you write off your meals? Can you write off your home office? Things like that. And again, it kind of gets down to, there are, the good news as a gig worker for rideshare and delivery is, you can write off a heck of a lot of miles, because that's all we do is drive. If I were a consultant, if I were, if all I were doing was running a website or something like that, and to write off 25,000 miles doing that is a little out of the ordinary for what I'm doing. And, and in that type of a business, that could set off a lot of red flags. For rideshare and delivery, it really doesn't set off the red flags, but there are other things that aren't as normal for what we do that could set off the red flags.
Like home office on a rideshare could set off red flags.
Yeah.
Although in some cases, somebody maybe could legitimately say that they use a space in their home solely for,
like me,
managing the rideshare. Well, you do for your business, definitely, 100%.
By the way, Pedro,
but as rideshare as a business, it's.
By the way, Pedro, Marissa is an expert. So there you go.
Yes, keeping your receipts are the best thing, because it's always better to have extra receipts and be told you can't write it off than to be told you could write something off that you didn't track.
Yep.
So
yeah, if you've got any idea at all that it's something that you can write off, hang on to that receipt and keep track of it, because you can always decide
and
later
Gary,
on not to use it.
Gary, you definitely can do home office. I mean, you're coding, right? You could do meals too. I mean, even most businesses can do meals, but it's tricky. I mean, you can't just go out to eat for lunch when you're driving and say that's a meal. Now, if you were legitimately meeting with a bunch of several drivers or another driver, and you guys were going to sit down with pen and paper and discuss a driving strategy and work out a you know, I don't
Yeah,
know.
let's say if
You could make
if
an
us
argument for that.
Denver drivers here decide we're just going to get breakfast somewhere, at any of these restaurants that haven't closed down, like Breakfast King is gone, but if we all decide we're going to get together and talk shop, that's a legitimate meal.
Right. And by the way, this year and last year, if you are writing off meals, if you can legitimately write off meals and you buy them in a restaurant, it's 100% deductible. Yeah. There's not 50% like normal. And it's just a temporary thing. I think that will change, but
driving through, grabbing a meal for yourself at McDonald's while you're out on a ride or out on deliveries or something is not, there's not a business purpose to it. And unfortunately, just keeping yourself alive so you can keep working is not considered a business purpose. So it's still a personal expense. There's got to be, basically, to write it off, there's one or two things that has to happen. Marissa, you can, and maybe this is the way I understand it. One or two things that has to happen is that either you're meeting with multiple people, more than one person for a business purpose, that there is something that you're trying to accomplish for your business, sales meeting or networking or something like that. The other option would be is if you were on an out of town business trip, and I think it's got to be like 100 miles. Marissa, you can probably fill in details on that. If you're on an out of town business trip conducting business in a place where you can't just drive home at the end of the day or something,
right?
Your meals for that trip could be taken. But unfortunately, in most rideshare and delivery situations, we don't fit under those categories.
I write off meals. Like I might have some workers come and work for the day. We're going to have a meal in the morning. We're going to go to a restaurant, sit down, make a plan for the day. I would write off that meal.
Yeah.
100%.
Yeah.
But it is because we are actually conducting business, making a plan.
Exactly.
And you have to take notes about that too. I can't just say, oh, I was having a meeting. I think I cut out.
No, I think I still hear you.
Did I get lost? Oh, okay.
No, I can hear you anyway.
Right. You have to actually take notes and be able to explain, write on your receipt when you save it.
Mm-hmm.
If you're tracking meals, anything you're tracking, it's a good idea to make a little note on whatever receipt you save so that when tax time comes, you don't have any questions.
Steve, we can do a Steve.
What's going to be the business purpose of your ski trip? I mean, that's the key. You can come up with a business purpose. I mean, do you do your own taxes, Gary, or do you use TurboTax or something like that? Or an accountant? I imagine you're doing, you have some kind of S Corp, or are you? Yeah, there's definitely advantages to going with the S Corp when you can write yourself a paycheck.
Yeah. Yeah. And then there's all sorts of, fuzzy things that you get into with, the kind of business that you set up, and there's, you can create an LLC for your business. That really doesn't give you any tax advantages unless you tax yourself as an S Corp.
Right.
And usually you can only do that if you're just making a heck of a lot of money, and you're making enough money that, you're making more than, I guess, a reasonable salary, and the IRS has all sorts of rules about that. And so there are some things that what you're earning might not be subject to the self-employment tax, and then that's where that's going to happen. It's really rare for that to be a solid case, I think, in rideshare, in gig economy work, unless you've got other money on top of it. But, and I think that's one thing that people want to kind of remember is we are looking at two different taxes, really. that we've got to pay attention to. And I think the one that throws a lot of people off is that self-employment tax.
Mhm.
And part of that is because, we live our life as, if we're W-2 employees, we kind of live our life never having to worry about Social Security and Medicare. It just gets taken out of your check, right?
Right.
And so we don't have to file a form. We don't have to do anything with that. So I think it's not even on our radar. And then when you get into something where you're self-employed and there's no employer taking that out for you and you've got to do it yourself. And now all of a sudden, we've got to take the money out. We've got to file a form about it and everything like that. And one of the reasons that throws people off is, with income tax, you can go out and you make $12,000 and you don't have to worry about the income tax because your standard deduction is going to take care of that.
Mhm.
But with the self-employment tax, it's treated just like, well, it is. It's Social Security and it's Medicare. And on a paycheck, if you ever notice, like you had a smaller paycheck and no federal withholding was taken out and there was no state withholding, but they still took out FICA. You say, who the heck is FICA? Why do they get my money?
Right.
And that's because your Social Security and your Medicare are taxed against every dollar you earn right from the beginning. And that's the part that throws people off. And unfortunately, as independent contractors, we pay twice the rate that we do as an employee on those things. So 15% of our profit as a business is taxable for self-employment tax. And it doesn't matter if you're getting standard deduction or itemized deductions or anything. And it's not like you have to wait till you make so much money like it is with income tax. You owe that money right away. And that's the part that I think probably gets most gig workers in trouble, is not understanding that self-employment tax and being ready for that. So you can go out and make $12,000 and there's at 15%, that's, $1,800 right off the top of the bat. That is a tax that is owed. And you still don't owe any money on your income tax yet or something like that.
Well, one thing to remember though also is that generally when someone is filing a Schedule C,
Mm-hmm.
they are writing off a lot of expenses.
Exactly.
So
especially with the
they're
miles.
actually being taxed probably on less income than they really realize in certain situations, so I believe that's the method behind why they increase that, because if people aren't paying, are writing off all their income and not contributing to these type of programs like Social Security, then there could be a really big crisis, when everybody reaches retirement age, especially with all the gig economy workers. So it is an important thing when you're contributing to it. I mean, I know it feels like you're giving money away, but
it's going to
really
come back.
It is a benefit that you will receive.
Yeah. And what happens there is, and the reason that it is twice is that when you're an employee, what happens is they take out 7.5% or 7.65. They take out, that part, and then your employer has to match that. So the employer pays half of your tax. Well, when you're self-employed, guess who your employer is? You get to do both halves of that Social Security tax.
Right.
And so, that's going to be in there. But I think you raise a good point about that, as far as that does go towards your retirement. Because I went one time and I kind of played with, they've got a little calculator over at the IRS about, what your Social Security is going to look like.
Mm-hmm.
And you can plug in your income for every year and it'll tell you what you can estimate that your Social Security is going to pay out.
You can actually go onto the Social Security website and create an account, which I recommend everybody does.
Yes.
That you create your account, because if you don't and someone hijacks your information and creates it for you, it's really hard to get back. So I would secure your Social Security account, and it will also tell you can get all your information.
Yeah, I think that's what I was thinking of, is on the Social Security site.
Yeah.
Not the IRS site.
So Gary, I saw your question here if drivers should file quarterly. If you owed $1,000 on income taxes that you had to pay last year, you should file quarterly.
Oh, I really want to say something here.
It is up for debate, but I know this was a thing last week. I would say you should. If
I'm
you
not going to go there.
generally you say 110% of what your last year's owed taxes are is what you should pay quarterly. The fee is pretty minimal. It caps out. It's not like it just continues to add if you're penalized. It's 5%, caps out at 25%, and it only goes for what was owed that quarter. So it's pretty. People who don't pay their quarterly taxes are not worried usually about the money that it's going to cost them for that small penalty. And all of these tax companies figure it for you. Like if you go to TurboTax, if you go to H&R Block and you're having to pay $2,000 a year in your taxes and you're not paying quarterly, you're paying a little penalty on there. It's on your form, but it's right at the bottom of your 1040.
Yeah. If you think you're going to owe money at the end of the year, then you should be sending some money in throughout the year so that that doesn't happen. And if you tend to normally get a larger refund or something because you've got kids, because whatever credits or whatever, or another job,
don't even worry about it.
Then you don't even worry about it because, you know, what your money that you're making as a gig worker then is going to do is it's just going to cut into your refund instead of making you pay more. It's kind of understanding how much more is your tax going to be compared to what would you normally get. And so, you know, if you think
if you're going to make a whole lot more money one year, then maybe you need to talk to somebody about it. Like if you're going to make $100,000 more this year than you did last year, you sold a property or you're just working double, you know, you should probably talk to somebody. But most people who have to pay estimated taxes already know.
Yeah.
If you don't know about it, then you're probably not in the category to have to pay, I would say.
Yep. Yeah. And the quarterly payments are, like you said, I'll blame the IRS for this because you go to fill out, if you pull up the form, the ES, the estimated statement form, and they've got a little, you know, worksheet on there that is like, you know, graduate level calculus trying to figure out that formula to figure that out.
Here's the penalty.
Yeah. Yeah. Well, figuring out the penalty is one thing. You know, figuring out their idea of what you got to send in or something like that. And I think it just intimidates the heck out of people, some of those forms like that. And it's really as simple as, you know, you save some money and you send it in. And that form is basically, the form itself is very simple. It's like, who are you and how much are you sending in?
And that's Mark pointed out in the chat how easy it is to go online to the IRS website and set up your account. You can make your quarterly payments. You can see if you owe anything. You can access all of your past records. You can get all your transcripts. It's a great tool. I would recommend people do that as well.
Here's the thing about if you're sending in money, if you're doing estimated payments, and that is that if you send in too much, you get a refund. It acts just like withholding, you know? So if you sent in money and then it turns out you didn't need all that much, it acts just like other withholding where you get a refund because you paid more than what you owe. And
right.
So
you get it back.
Yeah. There are some banks.
Which is the same as people overpaying on their W-2 taxes. They'll claim a lower deduction or whatever, or higher deduction. They'll have more taxes taken out so that at the end of the year, they end up with a bigger refund.
Yeah. So here's kind of how, you know, taxes work in a nutshell is it's like your income tax is a percent of whatever your total income is after you take out your deductions, you know. So, you know, say you're married, you made, between the two of you, you made $60,000 and you did the standard deduction. So your taxable income is $35,000. And and it's a percentage of that, 10%, 12%. That percentage increases as you make more money. And then your self-employment tax is the 15% of your business profit. You don't pay that on other income, just on your 1099 profits. That's the money that's left over at the end of your Schedule C. So those things add up. And then if you had any money withheld on a W-2 paycheck, that money's applied against it. If you did any quarterly payments, that money's applied against it. And then if you had tax credits, that acts just like a payment. There's a difference between tax credits and deductions. And so the tax credits are all of those things are kind of added up and compared to what you paid. And so if you paid in more than what your tax bill is, those two things added together, you get a refund. If you didn't pay in as much, you got to pay in.
Yep.
And of
you
course,
have
it's
some
more
credits-
complicated than that because of the way some credits work.
Right. You have some credits that just reduce how much taxes you owe. Like if you owe $1,000 credits and you get $1,000 taxes, you get a $500 credit. It reduces what you owe, but if you owe no taxes, it's not valuable.
Right.
There's also refundable credits that you can get back as a refund, whether you owe taxes or not. You could owe zero taxes. Those are things like the child tax credit.
Yep.
Some of the education credits are like that. But yeah, definitely. If you have kids, I would not be skipping out on filing taxes. There is a lot of great things going on for people with kids. As far as taxes go.
When my wife and I got married, it was a second marriage for us. We both had 5 kids.
Wow.
We had 9 living in a little
Can you
ranch.
imagine now?
Oh my gosh. Yeah. 9 of us, 9 kids plus my wife and I. And, living in this
Those
little
EIP
ranch with
payments would have been
one
awesome.
working bathroom for a while. And it was like, where was that money back then?
I know. Those EIP payments would have been like serious bank.
Oh my gosh.
With 9
gosh.
people in your family.
It
12
was,
people
well,
in your family?
one was in college already and the rest of them were in the house. So it was insane. We were so happy to be done with that.
Right. I guess it's not worth the EIP payments to go back to 10 kids in the house.
Oh no. It's like, we racked up a lot of gas points just from, $300 grocery bills and things like that. But,
I imagine.
yeah, there's a lot of things that really play in, and that's what makes it so hard. Somebody says, I see this on Facebook all the time. Somebody says, hey, I made $5,000. How much am I going to owe in taxes? And it's like, yeah, there's a lot of stuff that we got a lot of moving pieces.
The biggest burden of taxes is on the upper middle class. So everybody can complain about taxes all they want. I'm telling you, the upper middle class is paying out the nose taxes in a way that's, sort of unfair. You get to the wealthy and, who cares? They're not paying enough, but the upper middle class has to pay, pays the lion's share, really.
Yeah.
And I always kind of felt like all the years when I was raising kids, I felt like my taxes were kind of an adventure because it's like, back then it was like, how much refund am I going to get? I know not everybody's always in that, especially if you're making a lot of self-employment income. That might not be the case, but
yeah. And especially as they introduce those per child tax credits and those things and then the education credits and just a lot of different things like that.
And there's lots of energy type of credits. The ones for vehicles have mostly kind of timed out now, but they still have them for improvements to your home.
Well, and they've got, I think the ones for vehicles, and if anybody knows about this or has like gotten an electric vehicle, that it's like, it depends on how many years the manufacturer has been doing EVs.
Right. Like, I think the Tesla is timed out, but I think some of these like little neons might still be.
Yeah. Tesla and Chevy, I know have timed out, I think, because the Bolt was out for a while. I remember one guy talking about getting a, was it a Hyundai Kona
Yep.
or something?
Yeah.
And, you know, and he'll get the credits for that
Mm-hmm.
because it just
Yeah,
came.
there are
They're
some
new,
vehicles that still have them going on, and it's like,
and it's several $1,000s in the credit. And it's like the one thing that I might think about if I ever thought about buying a new car, that at least it kind of helps offset some of that
you buy
depreciation.
it for the tax credit, or maybe.
Well, it softens the blow, you know.
Right.
You know, how you drive a car off the lot and it's dropped $5,000 or $10,000 in value just the moment you drive away with it, you know. And if the tax credit helps at least ease that pain a little bit, maybe I would think about it.
Right. You know, one funny thing that's happened this year that I don't know if you've become aware of, but people who are doing things like Etsy. All right, if you're doing any kind of gig work or online business where you're getting paid through Venmo, PayPal, any of these payment companies, you could very well get duplicate 1099s. You could get a 1099 from the company who's paying you. Like maybe Etsy is sending you a 1099 for your income. And then you could also get a duplicate one from PayPal for the same money because they paid it to you.
Yes.
So if you are receiving payments through one of these payment processing centers, I would be aware of that and know that you still have to enter it in as income, but you will back it out as an expense.
And that's going to be a really big deal next year. Because with PayPal and, you know, Square and all these other places, not to mention Uber, that use the 1099K to report that income, they didn't have to report it until you made $20,000.
Right. And now it's 600.
Yeah. Yep. For this year's earnings and next year's 1099s, it's $600. So if you sell $600 on PayPal, you're going to get a 1099 for it. And with Uber and Lyft reporting their income on 1099K, a lot of people were making thousands and thousands of dollars and never getting a 1099 at all.
And not claiming their income.
And so they didn't have to claim their income. And that's why they made the change. And I think it was specifically because of Uber and Lyft, honestly. And a little bit because of Etsy and, you know, online sellers.
Well, and don't you wonder what
guys.
Uber and Lyft are doing with that income reporting?
Sorry,
you know?
I've got multiple things going on here, but I just put one on pause.
Oh, that's
to
all
jump
right.
back
Glad to
and
have
see
you
how
back.
things were going.
We're going. I've been trying to watch the chat.
Are
I
we-
don't know if I've missed.
Nope.
questions.
Where are we at? I'm sorry, I was like completely out of communication there. So
No, that's all right.
Oh.
We were just talking, and Steve, you and I talked about this before about the 1099 and the changes with that, and how they're changing the 1099K to $600 next year.
Right.
And
Well, a
so,
lot of people thought
Marissa,
that if
you
they
were asking
didn't
that
get a
question.
1099, they didn't have to report the income.
Yeah. And that's,
a lot of people didn't report it.
you know, a lot, especially part-timers, Uber Eats and Uber Lyft, they might get, you know, go out and make, you know, $15,000 or $10,000, and maybe they get a 1099 NEC for $800. And they're like, how come, you know, why is it so low? And because those two companies report it in two different ways. They report your fares and your tips on a 1099K, because what they're doing is they're saying, well, we're really a third-party payment processor. So the customer's paying you through us. It's a lie, but that's a long story.
It's a way to keep it off their books, right?
It is, yeah. Well, you know what it is it's a way for them to support the independent contractor narrative. It's a way for them to say, we're just a technology company trying to bring people together, rather than actually facilitating and organizing and providing the rides or the deliveries. So they just say, hey, we just brought this driver together with the passenger or with the restaurant. And, forget the fact that, especially with Uber Eats, that our pay has nothing to do with what the customer paid. It's
Right.
it's all just it's a narrative and everything. But the thing is like those stuff was all reported on 1099K, and they didn't have to send it out if you didn't make $10,000 or $20,000 on that.
Mm-hmm.
And then the incentives, so the surges and the trip supplements and the different things like that, those were reported on a 1099 NEC because that was money that was actually sent to us directly from Uber or from Lyft. So what's going to happen is, and it's already happened to a lot of drivers that are full-time, is you're getting two different 1099s from the same company, and you got to claim them both. And that's going to happen a lot more next year because of that change. And so you got a lot of Uber drivers that are used to never getting a 1099 and never filing taxes because of it, all of a sudden having to file their taxes and then trying to figure out, why am I getting two 1099s and all that stuff.
And the thing that you should know is that if you get a 1099, that means that the person who paid you reported to the IRS that they paid you. So if you don't file taxes, the IRS will tax you on that entire amount.
Yep.
Versus what you would file by writing off all your expenses, you're going to have a lot less income. So then you're going to have to go back and, get the money back. So if you get a 1099, know that you need to file or you're going to get a letter.
Yeah. Yeah.
So what all's been covered now? I'm sorry, guys. I am having like some technical difficulties on this side.
Oh, kind of a little bit of this, that, and the other thing.
Okay.
We've talked
You guys
about
want to
just
hear about some changes this year in taxes?
Yes, go for it.
So the standard deduction, which is what you would claim rather than itemizing your deductions, has nothing to do with driving and mileage or cars.
Right.
It is simply to do with, on your taxes, you're going to get some deductions. So the standard deduction for married filing joint went up to $25,100, which is pretty high. So it's kind of hard to itemize anymore. You don't want to, because the standard deduction. The head of household is $18,800.
Yeah, what was it before they made the change a few years ago? It was like $1,400 or something.
Right.
Yeah.
Well, but they used to give you the individual deductions.
They did,
which was like $4,500 a person. So we kind of lost deductions really. Child tax credit is $3,000 per child, or $3,600 if the child's under 6. That's a huge increase, and many people got that up front this year. Half of it. You could qualify for half of it. I do have a schedule that shows how much you qualify for based on your income, but you get the whole credit if you made less than $150,000.
Which is most of us.
Right. And then from there to $400,000, it slowly phases out. But yeah, most of us made less than $150,000. Tax rates. If you make $19,000, say $20,000 up to $81,000, you're going to pay 12%. 22% if you make over $81,000 up to $172,000. The people making $173,000 to $330,000 are paying 24%.
What a nice problem to have.
$330,000 to $420,000, they're paying 32%. The $418,000 to $628,000 pay 35% tax. That's a chunk of change. That's $35,000 for every $100,000 you make.
What was it? It was in
I think it was towards 628. It's 37%.
The end of World War II. I saw it that the top tax bracket was 94%.
Damn.
Can you imagine that?
I mean, if the top tax bracket is over 10 million, yeah, go ahead. I think that's
this
fine,
is true.
If it's over 400,000, then yeah, you're not going to make any money.
Although at that point, most of them have figured out how to make it so it's not really income or whatever. And so it's like Jeff Bezos doesn't have a salary hardly.
I wonder how, I mean, he has to pay himself a salary, right? He has to pay himself a reasonable and customary at least.
Yeah. But as much as he's making, he probably also has a lot of things that he can write off with it too or something. But
Oh, I'm sure.
most of his money is in the stocks and he doesn't have to pay taxes on that until he sells them. So,
Yep.
It's
a great deal being rich.
Oh, isn't it? Now, one thing I want to say on that, talking about those tax brackets, because a lot of people get a little confused with it, because, everybody's kind of afraid of, what is it? $19,000 is kind of that line where you go from 10 to 12 or.
Well, below $19,900. Yeah. 10 to 12%.
Yep. But the one thing that is weird about that is it doesn't change the tax rate for every dollar you make. It's a graduated thing. So your first 19,000 whatever is taxed at 10%, and it's always taxed at 10%. And it's only the money you make after that level that is taxed at 12%. And then the next amount of money is at 22% and so on like that.
Right. And you're only being taxed on post standard deduction. So you get to take, if you're married, you take 25,000 off your income first before they calculate how much taxes you owe. So really that 19,000 could potentially be,
and especially as a gig worker, there's a lot of things that are actually, if you're doing rideshare, if you're doing delivery, there's a lot of situations where you could actually end up having very low income tax, but a lot of self-employment tax because of all the deductions that go against that, so you do, if you're married and you got $24,000 you're writing off. And if your business made $30,000 in profit, you got a 20% qualified business income deduction that comes off. So there's another $6,000 that you take off. And on top of that, there's 7.5% that you get a write off for your half of your self-employment tax.
Right.
And, so there's a lot of things that come off. And if you're self-employed, you have more room to write off things like your health insurance or,
because you usually won't get to use those. You usually won't get to itemize. I mean, you have to make a lot of money to be able to itemize.
And so there's a lot of things that you can write off, and it doesn't matter whether you itemize. And then I think the important thing with that, and we've kind of covered that, since our taxes are based on our profit, all of those expenses that go with your business and all the miles that you are able to write off and all those things, you can write those off whether or not you itemize or take the standard deduction. And I think that that's one thing I see a lot of times in Facebook groups. People say, oh, I don't bother tracking my miles because I don't have a mortgage. I can't itemize my taxes, so I can't write those expenses off.
Yeah, and two totally different things there.
Yeah, they're totally different things. And that's why it's important to understand that your business or expenses are actually part of your income. They're applied against your money that you make. They figure out your profit, and those are figured out on your Schedule C. And so that gets us back to that whole point. Track your expenses, absolutely. If you're at a 10% tax bracket, every mile that you track is knocking about 15 cents off of something like about 15 cents off of your tax bill. And 15 cents isn't much, but if you're driving 20,000 miles, all of a sudden that's a huge difference because it's taking 15% off your self-employment and 10% off your income tax. So you got to track your expenses and don't get sucked into that myth that says that you can't write those off because you're taking the standard tax deduction. You can take those.
Right. The only thing, when you take the standard mileage rate, you
Mhm.
just can't track your car expenses as
Right.
deductions. Like if you're taking your standard mileage rate, then you don't get to take the cost of your car insurance, the cost of maintaining your car.
Exactly.
Those things are actual.
Right.
Totally different than the standard deduction that's related to your things like your mortgage and your health expenses.
Yeah, and I hear those get mixed up a lot in in discussions among drivers. Is they kind of confuse the standard mileage allowance with the standard deduction. One is a way that you can choose whether or not you want to list all the car expenses and everything like that, or you can just take a per mile flat rate. The other one is a tax deduction that comes at a different part in the tax process. And
It's similar with the home office too. You can
Mhm.
take a simplified home office, which just
Right.
takes the size of your office in relation to the size of your house as a percentage, and it takes a percentage. It
Yeah.
comes up with a set amount, or you can actually write down your household expenses,
Yeah.
and they reduce your income as a percentage.
What is it? I think one is $5 per square foot, and then the other is,
Is
doing
actually
all the math.
right.
and
Yeah.
and sometimes it makes sense on a car to do all the math. Once you get into a lot higher mileage, it's a lot less likely. But even then, there are times that, depending on the value of the car, that it makes more sense to do both. And I think it's a good idea to track both. Track your actual expenses, all of your gas, all of your insurance, all those things, so that you know what it actually costs to run your car.
Yeah.
But
Our
also track the
clients that
miles so that you can
our
take whichever
clients
one.
that run a lot of cars for their businesses, they track both, and we enter them both in, and it gives them the highest deduction.
Yep. Yep.
So, and you get to do it that way. I mean, that's that's part of the thing about taxes, is that you get to figure it. If there's multiple ways, legal ways, of course, you get
Right.
to figure it all the ways and see which one is to your advantage. And, in most cases.
Yeah. Yeah. And it's, and it's one thing I guess you could just say is good about what the government has done, where they've given a simplified version in a few different ways. Like you said, the home office, the standard mileage allowance, or even taking standard deduction versus itemizing,
Right.
that you can just say, okay, forget having to deal with all that stuff. I'm just going to write off $12,000 or $12,500 or whatever the amount is each year.
I'm sorry
And
though, but IRS and simplified just still don't belong in the same sentence. But I
no,
hear
that's
what
true.
you're saying. You're right.
That's
You're
true.
right.
That's true. At least, there were a couple, well, I think it was forced on them from outside, but
Right.
what do they call it? Paperwork reduction and stuff was why they
No,
did
those
that.
are easier ways to track and often help people, because really without the standard deduction, most people would not be getting that type of itemized deduction.
Right.
Right in close. So
yeah,
it is a benefit. So buying a car is a separate write-off.
It
Depends
is.
on how you.
Yeah, it all depends on how you're doing it. If it's and this gets to the whole thing of the whole actual expense versus mileage. So you could buy a car, especially with a used car. You could buy, a used car, and you could write off the whole thing the first year using special allowances, but you could only do that using the actual expense method. And the problem is, though, that if you do that, you can never take the mileage allowance ever on that car after that. So that's something you have to think about. And what the IRS did was they just said, you can either take all of the costs that go with owning a car and write off a part of it, or you can write off a mileage amount. It's one or the other, not both. And honestly, and actually, normally you can't write off a purchase price for an expensive item like that, because what you're doing is you're getting something of value in return for that money. And that car, as far as the IRS is concerned, it's more or less kind of like you've just got money for money, but it's just a different form of money. It's an asset. And so it's not an expense. It only becomes an expense when that car loses its value.
Right.
And so if you buy the car for $20,000, you sell it for $10,000, it's that $10,000 that you lost is the expense. And if you hear talk about depreciation, that's what that term is it's the money that it's lost. And you could
So
write that off over several years.
I believe a car depreciates over 5 years, or is it 7 years? I can't remember.
I think 5 years is what they say the
it
useful
would be
life
like
is.
taking the $10,000 for the car, and it's a write-off in equal increments every year. So you're going to get $2,000 off as a deduction a year, if you decide to take your actual.
Yeah, and here's the tricky thing about doing that too is, let's say you write off your car, and you do it through the depreciation thing, and you wrote off the total value, and then you turn around and you sell it. Now you've got to take that sale price as income. And that's why even sometimes I think it's even when you might be able to write off a little bit more using the actual expense method, you avoid a whole lot of complications just by taking the mileage rate.
Right.
It's
the same way with the home office deduction too. When if you don't do the simplified and you do actual expenses, you have to depreciate your home, which is going to give you taxes on the sale of your home for the depreciation recapture.
Yep.
So the simplified method, unless you do have a very expensive car to operate or something, is better.
So I've kind of been listening in as I'm trying to get my internet back up here. I think we're okay for a little bit. Bud Soda. Wait, why does this matter at all?
I mean, I would say in that
he was
case,
just talking
if
about
you're
writing
paying
off his car.
$500 for a car, you want to take your standard mileage rate. I mean, unless you're going to be spending $10,000 in repairs a year.
Right. Yeah.
I wrote an article once about what did I think was the best car to get for delivery. And I said, I think the most important thing isn't the gas mileage, although maybe a lot of people are going to disagree now when gas shoots up to $4 and more. Right. But it has more to do with how long can you, keep delivering with it and stuff, generally I kind of recommend on the delivery side, get an older car where most of the value is already gone. Get a $2,000 to $5,000 car in good condition that's reliable, and drive the wheels off of that thing. Sell it after a year or two and just rinse and repeat. And you lose a whole lot less money than you do buying a new car, dropping $10,000 off the value, and you drive it off the lot, plus all the extra costs that go with it. And I feel like even today that my 20 mile a gallon SUV is a better car for delivery than a Prius. Right. And it's for one reason only. And that is that there's no way I could keep delivering in a Prius. I'm 6'5" and I'm not a tiny guy, and I don't fit in those things. And it's uncomfortable as all get out for me. And I couldn't keep delivering. And so, I might spend less in gas, but I'm going to make less money too, because I can't keep delivering. So I think, get a reasonably priced car. And if you like driving it and it's really economical, then that's a good reason to go that route. If you're really miserable driving an economical car, it's going to cost you more in opportunity cost. And I'm going down a rabbit hole here that's getting away from taxes, right. But it's all about making the most of that value of that car. And if your actual cost per mile is more like 20 or 25 cents and you get a write off 56 cents, that's a nice little windfall. So that's my
So
thinking.
I was going to say, Driven Dad, that yes, if you rent your home and you have a designated space in your house for your home office, you can write off that square footage for home office, either in the simplified method or by, we have people who rent a house and they have a room in that house that's their office, and they use their rental expense as a percentage that they can write off. So yeah, definitely. But
Couple
you have
things
to
to keep
use
in
it.
mind
You
with
have
that.
to, you know, follow some rules about it. Really is where you run your business, and it's not like it's also the kids' playroom and, you know, where you sleep. You know, you have to have, even if it's a 4 by 4 foot space, that's what you do there.
And that space can only be used for your business. And so that's the important thing, is if you have space that is only used for your business and it's used significantly by your business, it's kind of hard to do with, you know, a lot of gig work because all of your work is done on the app.
I mean,
But
if you're selling something online, then 100% you could
absolutely, yeah.
find a way to figure it out. But yeah, if you're driving as your business, it's,
You know,
it's
and,
not
and I do two
impossible
different
that you
businesses.
could-
I've got my delivery business, and I've never tried to write off my home office for that. But then I've got my website, and that absolutely is a legitimate expense there. So if you've got a business that actually requires you be working at the home office, then that home office is absolutely something to write off. Yes, YouTube work. And, you know, if you got to set up a studio, if you're setting up a studio,
YouTube,
there's
100%.
more space involved there. You know, it's not just a desk. And so it's, you know, it's all based on how much of the space in your house is being used. Yes, if you're a YouTuber, you
using
live stream in
an
that office.
that you live stream in is a legitimate office. It just depends on if you spend, you know, a fifth of your time in the office live streaming and the other 95% doing other things, or, you know,
Yeah.
or if you're really using that, it's exclusively for your business.
Yeah, when you're doing content creation, any of that type of stuff, make sure you give yourself space that you're going to use only for your business, because you can write that off. And, you know, as well as the items that you're using to run your business, that's all, you know, part of the expenses. There's a lot of, that's where the details get a little tricky sometimes as far as what you can and can't write off as an expense. But, you know, as long as you need to use something to make your business work, then that's an expense for your business. And as long as, you know, you're creating space that you're using for your business out of your home, then you can definitely claim all of that stuff.
So, what else do we got that gig workers can use to their advantage, so that we can kind of round this out at the top of the hour?
One thing I'll throw in here, you know, talking about self-employment tax, there's the one side where we try and keep our taxes low, which obviously we should. But, you know, this is one thing I was getting to when I was talking about estimating what the payment was. When I was playing with the estimates as far as my pay, it was like every dollar in tax, if I'd add $1, you know, what that would increase, or if I added $1,000, what that would increase to my monthly rate. In about 15 years in retirement, that monthly rate has made up for it. You know, if you're going to be retired for 15 or 20 years in Social Security, every dollar that you reduce in Social Security taxes is going to reduce how much you get in Social Security later on down the line.
Right.
And now, if you only think you're going to, you know, you're going to retire, flame out, and you're gone in 5 years, probably didn't matter as much. But, you know, what I'm saying though is, because of all of the write-offs we get for our business, especially if we do this full time, you know, you can get by and you're only maybe making $15,000 that you're taxed on. So your Social Security tax isn't as much, but it will impact how much you get later on when you retire.
Right.
And so the whole point of bringing that up is if you're going to get less in your retirement because of all your tax write-offs, you really want to think about what you're going to do to offset that. Are you putting money aside for your retirement? And so that is something that you want to do. And because you're self-employed, you have a higher limit because you can use the self-employed IRAs or the pensions that you can set aside more in a year. Although usually, I mean, I always saw that and I said, oh yeah, I could set aside more, but I can't afford to set up to the limit anyway. So it didn't matter that much to me.
And I was also going to say, anybody who is thinking of buying a house or buying a car and you have your self-employment income as your income, if you write it all off in expenses, you're going to have a hard time securing a loan. So in that way too, if you're looking at making a purchase where you need to use your credit and borrow money, don't be frivolous and write off every dollar you earn. You want to be able to show.
Yeah. You walk into the bank and you say, I made 60,000 driving Uber. And say, oh, great. Let me look at your tax return. And your tax return said you made 5. The bank's going to look at the 5, not the 60 that you got from them to begin with, because they look at that just like the IRS does as a business. And your real income is what's left over after all those miles and expenses. So those are things you have to think about. And that's a good point.
And that's also what's reasonable too. I mean, one of the things a tax preparer that's helping you file your taxes or anything, they're going to ask, is the income that this person earned enough to support them? And if it's no, if your taxable income isn't enough to support you, then they're going to have a hard time getting you things like earned income credit and some of the tax credits that come with it. You know, if you're living in Boulder County and you show on your taxes that you made $8,000 last year, you're going to have some explanation of how you survived.
Marissa, have you ever seen this before? I've noticed this with a couple of people that, asking questions, and it turned out that because they were able to write everything off, their tax refund went way down because now they didn't qualify for earned income credit.
Oh, definitely. Earned income credit is like on a bell graph. Yep. So if you start qualifying, say at $500, and it goes up to about 22,000 is the sweet point, and then it starts to go down and it's bottoms out at 50,000. So I think the high amount was almost $7,000 this year. So the less income you have below that sweet spot, the less earned income credit you're going to get back. And in fact, you could, if you write off all your income, you won't get any of that back.
Yeah. Yeah. And that was the first time I heard about that and said, oh yeah, I took my expenses out of my TurboTax and I got a bigger refund. And I thought, well, that can't be. And it turned out that's what it was that earned income credit. So
that is something to watch for. If you're putting in all your expenses and it's affecting the potential of an earned income credit, then you might be shooting yourself in the foot. It is good with that software that you can do things like that. You can go back and kind of play with it, see the result, not in a way to help you to cheat, but in a way to really help you optimize.
Well, and then I've heard of people that I've heard of times that the IRS has kind of cracked down on people because they said they didn't claim enough expenses or something like that because they were doing that to try and get their earned income credit back up, that the IRS actually wants you to claim those expenses if you had those expenses, which is
right.
Anytime it suits them better, that's what they want.
Yes. I feel like Steve might be saying something to us. I don't know if he's talking to us or.
No, that's Tom Kelly for the radio show telling me that how can I be in 2 places at once and I can't. And he was all alone when I left him. And this was just, this all should have happened the other night. I don't know. This was, hopefully everything was okay when I was off. I mean, if I could, I would go back off and go to the radio show because I think these guys are helping you. I don't really have a lot to add. In fact, I'll probably go back and listen to this myself. But if these guys are okay to just talk for a bit, I'll bounce over to there so I don't get yelled and screamed at.
Yeah. Bud Soda had a question. In the meals, how far away
Okay, I'll
do
be
you
back
have
in a
to?
bit, you guys.
How far away do you have to travel to be eligible for meals? For example, I'm an hour and a half from a market. I work sometimes, or about 80 miles. I think the general rule of thumb is you got to be far enough away that you got to have an overnight stay. I don't know if that's oversimplifying. Marissa probably has better detail on that type of thing.
Looking for a distance.
You could do
80% of meals, 100% restaurant. I'll have to look that up. I'll get back to you, Bud Soda, but I'll figure that out.
So I did. If you do a search, because I think in this article, I ended up, like pulling up some of the information from the IRS form. If you just search for the question, can I claim meals on DoorDash? And the same thing's kind of true with Uber or some of the others. But if you do that, you'll see a search result up there from EntreCourier.com. That's the easiest way to find that, because I don't know how to put the link here in the chat. But if you do that on Google, search for "Can I claim meals on DoorDash?" and just look for EntreCourier. There's an article where I, looked into that and tried to pull up whatever I could from the IRS site as well, that I think went into some of the details.
So it's 100 miles. It is.
Okay.
You must be 100 miles from your home.
Okay. Or you just listen to Marissa because she's right there.
I just looked on the IRS website, but yeah, I mean, I don't know. What do you think, Ron? Does that apply to DoorDash drivers? I would think so. I mean, if you're 100 miles from home, it's not like you can run home for lunch.
Well, that's true. Although you can bring your lunch with you. It's not
You can.
a
This
whole
is
lot
true.
differently.
I would, if you were going to do something like that, I would go on, save the little blurb from the IRS website that says you must be 100 miles from home, and print it out and put it with your tax files and say, this is what I used to determine that.
Mm-hmm.
And then they can decide and say, no, we disagree, but it's not fraud then. At least you were trying,
Yeah.
I would just document. People are you could ask 5 different tax preparers about this meal question, and you're probably going to get 5 different answers.
Yeah.
And they could all be experts and all really know what they're talking about. They're just not going to see it the same way.
Yeah, you couldn't when you got per diem work at because that's untaxable allowance income. So when you're an employee, they can sometimes just say, we're going to give you so much money per day. And it is an actual, it's considered a reimbursement, so it's not taxable income when you're an employee. And so, but that's another one of those things where they, I think, tried to simplify, where they'd say, we'll give you a per diem, that it's going to be so much per day. And that way you don't have to worry about all the record keeping and all the receipts and all that stuff. It's just going to be this much. And this is especially if they're sending you away on a business trip. And unfortunately for self-employed people, we don't get that option. We can't give ourselves a per diem.
I mean, you could now, right? With your S-corp?
Yeah, as an S corp, probably. Well, actually, I don't think I can, because if you're the owner, you don't qualify.
Oh, that's right. And probably your family members too. There's some rules about that.
Yeah. Doggone it. Oh, well.
It gets complicated.
I guess I'll skip that trip to the Bahamas.
I could do that easily. It takes me 100 miles out of delivers. All right. Don't quote me on it. I'll send you the IRS link.
And that's an important thing to bring up here. Guys, everything that we're saying here is not tax advice. What we try and do is just kind of give you as much information as we can, but we're not giving you tax advice. Don't take this as tax advice. There's one thing to kind of try and understand how it works. But if you need tax advice, go get a tax pro. And that's probably the other thing I would say right now is, we tried this once before and we were confused by the time it was all over with because just how some things went. And sometimes, when you get people talking about taxes, it can get really confusing. And that's maybe the best advice that I could give that isn't tax advice, but maybe is tax advice. And that is, if you're at all confused and if you're all really just like, okay, this is just overwhelming, get somebody to help you with your taxes. It is so worth it. They are probably going to pay for themselves many times over because they're going to find the things that you never thought about. And they're going to keep you out of trouble. As long as,
one thing I would add to that is that, here you guys are listening to us for tax, for some information on taxes, but unless somebody has your information in front of them and is looking at your numbers and your documents, I wouldn't put 100% cloud in what they're saying because everybody's situation is a little different. So yeah. I would definitely, when you're really looking at getting some information and want some help, make sure you're working with some real numbers and not just in theory.
Yeah. One person could be making a ton of money and they're still getting a big refund because of all the credits they get. And because, they also happen to work a W-2 job where they're setting aside a lot of money. Somebody else might be only making 20,000 and they still have to pay in. So everybody's different. And there are so many moving pieces that it's just really hard to say just this or that.
Right. And what was last year is not necessarily this year. So
yeah, very true.
But you got TurboTax and they got it all figured out. So if you're going to use, if you're making, under $50,000 a year and whatever, I would say something like TurboTax is probably pretty adequate as long as you kind of have an idea of what you need to be gathering and bringing to the table.
Yeah.
If you're making a lot more than that, I would seek a tax accountant.
Yeah. And I would say if you are trying to do your own taxes, spend the money on the self-employed version to begin with. I've seen a lot of people, I think, try and do the free tax programs and some different things like that they don't have Schedule C support. And then they get done with it and they say, well, where do I put my miles? Well, there's nowhere you can put the miles in that particular program because it's not designed for self-employed. So look for self-employed on the tax package. Look for Schedule C support or 1099 support. And it's a few more extra dollars for the TurboTax or the H&R Block version. Most of the free programs out there can't do it. A year ago, I tried just running taxes on Credit Karma because they had a free version that did self-employment tax, and it missed so many things. And I knew what I was looking for, and it was still so hard to get that figured out, how to enter that stuff in. So some of the more expensive programs, I'm not trying to, shill for one tax program or another. But some of those more expensive programs are actually expensive because they're good at walking you through. Right. TurboTax and H&R Block are a lot better at walking you through and asking you the questions and making sure that everything is there than most of the free programs out there.
I used to do I always did my taxes by hand, downloaded my forms, put them in. That's kind of how I got into doing taxes. But when TurboTax was first coming out, I sat down with my completed taxes and tried to duplicate it in TurboTax, and I could not make it work out. I haven't tried it since, but I could not. I was like, well, everything's worded different. Yeah, it was confusing to me. But people who use it all the time or start that way, you just learn that way. So I think I don't like TurboTax. I know it's awesome for a lot of people.
Here's one thing I will say that is good about TurboTax is they know what to do with the Uber and Uber Eats tax summaries, because it can
Yes.
actually log into your account and it'll download the summary, and so it knows right away where to put the income and where to put that the service fees. And so if you're on Uber and you're going to try and do it yourself, that's the first place I would go, just because it knows what to do with that stuff. And it's really confusing if you don't know what to do.
And yeah, I think they've gotten better about walking people through it too. And assisting.
I think the problem is it is so hard to figure out what questions to ask people so that they know what you're asking. I don't know how to do that as well as I should be able to do just in conversations. So imagine trying to do that with a tax program. So, I ask you about, do you do this for business? And you could take that a dozen different ways. So that takes some talent to figure out something that can actually figure out what people are thinking when they're doing the taxes, so they know how to answer. It's kind of like creating secret passwords, You create a password and then it says, "What's your favorite movie?" Well, am I going to answer the same thing today as I did a year ago?
Right.
It's that kind of thing. So, asking the questions is not easy. And I think they have gotten better at it, but
Right.
ultimately, if you can pay the
taxes are
price.
such a complicated formula. But really there is some method to the madness. It's only that as time's gone on, they've tried to address every situation and every item, and they never will. But it just continues to get more complicated.
Yeah.
See, maybe
And-
someday they'll dilute.
and- Honestly, I feel like I would trust the software program more than some of these places you walk in where you got the dancing Statue of Liberty, where they want to do your taxes, because basically what they've done is they've just trained people how to run the software. And I think I would almost trust the software more than some of those places. But ultimately, the best thing you can do is just get somebody that really knows their stuff that you can just go to. And
Right. Yeah, we do this stuff all day long. So rentals, Schedule Cs. I mean, we did our business taxes already because those were due, but from here on out, that's all I'm thinking. Schedule C and Schedule E.
yeah, you're gonna eat, breathe, and sleep that stuff for the next month, aren't you?
Oh, yeah, I do, for sure. And I get they throw me all the Schedule Cs in my office. So that is what my next month for sure. And then the people who don't get their stuff in and have to, do an extension, I won't even look at that till maybe the end of May.
Yeah.
We might look back at that.
Oh, understand that. Almost $100,000 a year. That's pretty good.
What's this?
Oh, Bud Soda said he's on track to almost 100,000 this year. And
Earnings?
Yeah.
Are you paying your estimated taxes?
That, or you got a lot of write-offs, right? But I think that's possible. And there was the guy that was he did it on TikTok about a year ago, where he went out every day 12 hours a day for a whole month to see how much he could make, and it was like $8,500. So it was a pace for $100,000 doing nothing but Uber Eats.
Yeah.
And you could do it. And I looked at it and it was kind of like, yeah, hopefully I should be able to make better money than that, or make that money in a lot fewer hours. And it's like, but I think that's what's beautiful about the gig economy is you can go out and you can make that extra money and you can keep working those extra hours if you need to make that money.
Yeah.
And
I loved it. If I
Yep.
had ever been, when I was tight on money or, needed something I knew, I could go out and make $300 today.
Yeah.
Especially on the weekend.
Yeah.
But if I hustled, I could make that money I needed and it would be in my bank today.
Yep.
I could pay my bill tomorrow.
And I can tell you 20 years ago when my kids were young, it wasn't so easy then to just come up with money out of thin air like that.
Right. Would have been a great tool back then, right?
Oh my gosh. But, and that's what I love about, what we're doing is that you can do that. And it's just, the main thing is kind of stay on top of the money side of it and make sure that you don't get yourself in trouble because of the money you're making.
Right. Yeah, I used to have to clean houses when I needed some extra cash, and I sure would have rather been out driving my car.
Oh, I know.
Well, I don't see any other questions in here. I don't know if anyone else has anything.
I think we obviously haven't covered everything because that's impossible to do even in an hour and a half.
Right.
But
if I knew how, I would put the Schedule C up on the screen and whatever, but I'm not that talented with my as my first time in StreamYard aside from the other day, so I don't really know what I'm doing.
Let me see.
Okay. I'm a broke, well-off guy. All the money is going to investments. Oh, investments, taxes, and paying down debt quickly. Well, those are all good places for it to go. I mean, just reminds me, I ran into this guy in Boulder who was sleeping in a ditch. I didn't know he was there. He startled me, and he told me that he is a working bum, the kind with a job that can't afford a home. And he had all his tools. It was like, damn.
Oh my goodness.
Yeah.
I remember one time,
not
one
that
of the
that has
first
anything
times
to do with anything, but
riding on the light rail,
what's that?
working a late night job, riding on the light rail. And there was a guy that he kind of sat out on the corner way out off of like I-20 out by County Line, Park Meadows Mall area, where that was his territory, working and standing on the corner with a sign. And he'd be riding on there some nights when I'm coming home from work, counting out his money. And it was amazing how much money he was getting on that. And I was kind of like, and probably not paying taxes on that part. Let me see if this share button works. Share screen. All right. I don't know if this is showing up on the screen or not. I've got my screen shared with a Schedule C. I don't know if anybody's watching, if they can say whether or not that's popped up on the screen or not.
Driven Dad, I'm sorry, I don't know your name. Driven Dad, I'll call you. I think that generally when people are looking at doing an S Corp is like what Ron said, when they want to start paying themselves an income with a W-2 and participating in payroll taxes. There are some other benefits as far as like retirement contributions, maybe like the step plans or whatever.
Yeah. What, the rule of thumb that I've heard was like, especially if you're starting to make a lot more money than what would be considered a reasonable salary for what you're doing. And, the IRS requires that you pay yourself a reasonable salary as an S Corp. Probably as a delivery driver, that's probably going to be $40,000 to $50,000 for a full-time type of thing. But there's there are tools out there that you can look up to say, okay, you plug in the things that you do, and it tells you, it takes a look at what the average is for doing that type of work, and will tell you how much is a reasonable salary. The advantage of an S corp is if you're making a lot more money than what would be that reasonable salary. Let's say you're making a lot more than $60,000. The additional money isn't taxed, is maybe not susceptible to the self-employment tax. It's just income tax, but it's got to be a lot of money. You got to be making some pretty strong money before you do that. And you want to make sure you get all your T's crossed and your I's dotted, getting that set up right, and documentation of what your reasonable salary is to be able to do that. And so that's when that starts to make some sense. And then,
I mean, I was going to say the one thing about doing an S corp is that it's going to be a lot more tax complicated and a lot more complicated to run your business. So there's going to be more expense involved in your accounting and tax preparation.
Yep.
But so, yeah, when you're making enough money
I'm learning that lesson
to make that worth your while, you want to protect yourself and do it the right way.
Yeah. For my website, I set up an S corp, and I'm not at a point where I'm at that like making a lot of money type of thing, but it was making enough to kind of give myself a salary. And part of my reasoning for doing that was what Marissa mentioned, was to be able to give myself an actual payroll paycheck. So I set up with a payroll company to pay, like a monthly salary and everything like that. So I get a W-2 from my business. You can't do that as a sole proprietor for yourself. You've got to be incorporated to give yourself that payroll paycheck as the owner of your business. And to me, it costs a little bit more to do it that way because of all the different things and the tax stuff that you got to do. But there's something nice about, one, it's just the taxes the withholdings are already taken care of. And two, it works a lot better from the purposes of like getting credit, because we're getting a construction loan for some work and some different things like that. But the best thing there is, that's especially a good tax pro question to sit down with somebody who can go over your situation to say whether or not that makes sense. Another question that some people will ask is, well, what about doing an LLC? And is there a tax benefit to doing an LLC? And honestly, the taxes are in most cases pretty much identical to just being a sole proprietor. And Marissa, you can probably tell a lot better on the tax side of that. From my understanding,
No, it's true. They're all going to file the Schedule C unless they decide to tax themselves as an S corp. But yeah, the LLC and the sole proprietor, the difference in an LLC is that you can, if you handle your accounting right, you can protect yourself against liability in the business. If somebody sues your business and you have an LLC, then you can feel like your personal assets, your house and your car, can't be touched in that lawsuit. However, if you have an LLC and you commingle your accounts, like you have one bank account and you pay your business expenses, your personal expenses, everything goes in there.
All that money you spent setting your LLC up was wasted.
Right. Your LLC isn't going to protect you. You've already broken the barrier of protection by commingling. So if you have an LLC, get a separate bank account that all of your business is handled through, I would say.
I think the question with an LLC, ask yourself two questions, is one, what are the chances of your business going in debt to a point that your creditors might come after you? And two, what are the chances of somebody suing you or suing your business? And as part of that, they're going to come after your house. If you don't have assets, an LLC probably doesn't do you a whole lot of good. If you don't have a house, if you don't have a net worth, if you don't have things that people can get, it probably doesn't help you a whole lot. And when it comes to gig economy stuff, I think the chances of going in debt are very small because there's really not a cost to running your business, I think, other than your car. Okay, if you drive around and you cause an accident and you didn't get the right insurance, and now they sue you or something like that, that's where your risk is really the highest. And I think that's, I think there are a lot of things that if you do the right things, you get the right insurance while you're doing your work, probably your need for an LLC probably isn't that great. But I think it's kind of when you're really starting to make some money that's when you start thinking about the LLC doesn't help you, but maybe now getting the S Corp might.
Another reason for an LLC would be if you're going to have multiple people involved.
Yes.
You would form an LLC.
Right.
Generally, though, people don't move up to the next level until there's some financial motivation, because every time you move up to the next level, it's more complicated bookkeeping. But there definitely does become a time when it's more cost effective in many ways.
Anything else?
So, well, this was fun, Ron. Thanks for
It was, yeah.
chatting.
Enjoyed this.
I'm going to check out your webpage and some of your articles.
Oh, thanks. Yeah, I've got kind of at the bottom, I've got like all the different categories and stuff like that. So usually you can kind of get an idea of where, the tax stuff is. You click on that and then it'll list all the different tax articles and some of the other stuff about other types of articles. So put out a pitch to anybody listening, EntreCourier.com. EntreCourier. The idea was Entre was to stand for entrepreneur, and then courier just doing delivery, because that's what I started writing the most about was DoorDash, Grubhub, Uber Eats, things like that.
Yeah, I'm sending Steve a quick message that we're getting ready to wrap up. He might want to pop in here. I don't know.
Yeah. Yeah, he kind of leaves us in charge of the studio here. That's a dangerous thing to do.
I know, we could get him in trouble here.
Oh,
No,
what kind of things
never.
could we talk about?
I know. I don't know what about taxes.
Of course, he can always edit and chop off whatever we say. So I guess
you can edit it out.
And while we're getting Steve in, like I said, I don't know if anybody was able to see the Schedule C that came up. And I always call the Schedule C our version of a W-2. A lot of people think it's the 1099, but again, the 1099 is just the money that you got from Uber or DoorDash.
And the Schedule C comes up with all the deductions like a W-2.
Yeah. And so what Schedule C is, they call it profit or loss from business is the title. And, so you put in your income, you add up all your income from all your different sources, you put in your expenses, and then the money that's left over is the income that gets moved over to your tax form, just like with your W-2 or other types of income. So it's kind of like you're creating your own W-2 in a way.
Yeah, because the W-2, the amount that it says on there is going to be the amount that you got in your hand, like your profit after your expenses or your deductions. And that's what your Schedule C works out, is the formula to come up with that net profit of what your income is going to be.
So,
well, I don't
see there it showed back,
up.
So. There's your schedule. Oh, well, it's gone now.
Oh, I saw it.
Yep.
Oh, wait.
If you didn't blink, you missed it.
You weren't able to share a screen?
Well, I did the share screen, but it didn't pop up there. So I probably didn't know the right thing to do to make it show up on the screen. So, okay, I got to quit trying to wear headphones with a fedora. It just doesn't work. So a couple parts here. We'll just kind of run through this real quick, just so you got an idea of what it looks like. And it's really pretty simple. The first part is kind of the who are you, your name, social security number, or your EIN if you've got a business ID number. The second part is the income. And you'll notice there's just one line on here.
The rideshare code up there, the business code, if you're a rideshare driver, right in here, right in the show where that business code goes, is 485300.
Okay.
If you're a delivery driver, it's 492000.
Yep. And basically that just tells the IRS what kind of business you're running. And when we were talking earlier, we talked about how, if you put in some kind of business code where you don't do a lot of driving, all those miles could end up being a real red flag to the IRS. That, oh, yeah, that home consultant doesn't normally drive 40,000 miles. And it's going to say, yeah, maybe we better look into this return. And so having the right code helps a lot, especially because of the kind of miles that we drive. Here's the interesting thing, and I think a lot of people don't understand this, is, let's say you get about a dozen different 1099s, you do some courier deliveries, and you do deliver that, and you do DoorDash, and you do Uber Eats, and you do Uber, and you do Lyft, and everybody gives you a 1099. And all of that goes into this line 1 under income. That's it. And it's, and I think a lot of people get worried about, well, what if, and then if you had money that didn't show up on a 1099, you're really supposed to add that in there with it also. Now, if you're doing TurboTax, it'll ask you all the details from your 1099s, but on the Schedule C, the only place that you put all that is just this line 1. You add it all up, you put that there. And then part 2 is the expenses, and that's where just all these different categories, the types of things. And so every time you've got an expense, you kind of categorize it. And
so those fees that Uber and Lyft put on your summary that they take out before you get them, that would go in line 10.
Yep. Commissions and fees.
And on line 17, you could put whatever you paid to file your taxes.
Right.
If you had to have a lawyer for your business or any kind of legal.
And the yellow page ads you run for your business, okay, I guess we don't have those. So forget advertising. But if you do, let's say you buy stickers to put on the bags to, you put stickers on your delivery bags or something to try and encourage people to tip. Yeah, that might fit under advertising. I'm not sure. There might be, I don't know if that'd be better under supplies or advertising, but since it's trying to kind of encourage getting more money.
Right. The only other lines as a driver I would think you would use is 22 for supplies. If you are, buying water for people or something. You
Marissa,
could put some of those Uber and taxes and licenses if you want.
I was pretty sure I read somewhere on the website at the IRS. In fact, for the longest time, I was trying to find something like that. And then I actually saw it just kind of stick out at me about interest. That interest on your car loan is actually deductible, even if you take the standard mileage allowance. It's the business portion of your interest. And actually saw somewhere where I think the IRS actually put it into those words. I wish I could find that. And that's one that you definitely, I think, at least want to check with your tax pro about something like that.
Right. And I hear it both ways too. The same with like car washes, that's very debatable. A lot of people say if you're doing the standard mileage rate, you can't take car washes. However, for something like rideshare, where you have people getting in and out of your car all the time, I feel like people can have an argument that this is an operating expense separate from your vehicle expense, especially if you do something like a monthly service. You pay $30 for unlimited car washes. But
so
I would guess
that
you could probably write off car washes for rideshare a lot more easily than you could for delivery, just because ultimate cleanliness is such an important part of your rideshare business.
I'm gonna interject here real quick, guys. So the radio show that I do on Friday nights is normally 4 of us. It's just 2 of us tonight, and I'm gonna go over and help him for a minute, but I'm gonna come back in 11 minutes to shut this down. So
Well-
whatever questions you have, if you guys want to get them out, is that enough?
I
time
think
to-
we've kind of been through most of the
Okay,
questions. If
okay,
you want to
should-
wrap up now, let's go.
Yeah,
ahead
I'm just
and do
not
that.
trying to rush it.
No.
Because I know that obviously every time I've looked over, you guys are talking, you're putting out good information. So, I guess anybody that comes and listens to this after the fact, sorry that we had a little of a cluster there today. Normally it's not a big deal if I pop out of the radio show for a little bit. Right now those guys are on their own, or Tom is on his own. So I'm
We've
going to
got a
hop
bet
back
with
over
Steve
to that.
to see how many shows he can run at the same time.
That's not what
So,
I do.
but Soda, I see your question here. Are you asking about you use hot catering bags and cup holders for
Absolutely.
delivery? That those are definitely a write-off. I mean,
Yep.
that's something you're using to operate your business.
All right, guys. If you have any
That's
any
what
more
that's-
questions for these guys, you can post them in the after show notes, and I'll just put them in the comments. And anybody who watches this after the fact, put them in the comments, and hopefully I can get Ron or Marissa to come back and comment on them. So maybe that'll bring out more questions, because I know a lot of people are out working right now too. Timing was an issue on scheduling of this too, and not just with my conflict right now. Just in general. So this piece will be out there for the people that I know wanted to see it who weren't here today. So they'll listen. They'll probably have questions. They'll post them. If you guys wouldn't mind, I would love it if you would come back and just kind of scroll the comments, see if there's any, and maybe check in a day or so. But then that way we can wrap it up and let everybody get out of here. I feel bad because that's my duty on Friday nights, and there's 4 of us, but tonight there's only 2, and I just got Jesper to join in. Or Jason's partner from the Gig Economy podcast. So now he's on with Tom. I really gotta bounce
That's
back
fine.
over to
No.
there. Normally this wouldn't be an issue and I could be here. This wouldn't be a big deal, but
Well, hey,
I
we
really
went-
appreciate you guys helping us out with this, and I am sorry that I had to bounce, but really these guys
No
were probably
worries.
the better information than me on this anyway.
No,
So
no, this
thank
went
you guys
great, so,
very much. And
Thanks
if you
for
have
having us,
comments,
Steve.
post them in the comments.
yeah. Thanks,
And
everybody.
Thanks for joining.
You bet.
Thanks, everybody.